Nearly every financial empire was built using leverage. Most people have used leverage to finance their college education in the form of student loans. You probably leveraged a bank's money when you bought your home using a mortgage loan. And if you own a business, you probably use leverage in the form of business loans and lines of credit to invest in the expansion of your business. But did you know that you could also use leverage to purchase your life insurance policy? Well, let's take a look at why this makes sense instead of just paying the expensive premiums out of pocket. Well, let's say a client needs $40 million of life insurance and was going to pay $1 million in annual premium for 20 years. If they used a lender's capital instead and borrowed $3 million a year in the first 7 years, they'd be able to load $21 million of premium in those first 7 years. And even at a borrowing rate of 5%, the interest payments would be about $1 million a year. Similar to the premium outlay in the non-finance policy. But due to the fact that the policy's cash value can be used to pay off the loan in year 16, the total interest outlay is only $12 million versus the $20 million outlay in the non-finance policy. So right off the bat, financing makes sense, using a lender's capital to front-load the premiums. At Landsmark Capital, we can custom design this strategy for the client, but we also have a proprietary program called Leveraged Index Arbitrage that produces 24% more cash value and death benefit than traditional premium financing, with no outside collateral requirements and no personal guarantee requirements either. So here's how it works. On the left-hand side of the screen is the traditional premium financing design we saw earlier, which is great. But on the right-hand side of the screen is our Leveraged Index Arbitrage program. Here we have the client pay the first year premium out of pocket and then begin borrowing in year 2 of the policy. The client pays lower interest payments, and they exit the loan a year earlier because they borrowed 6 years of premium instead of 7 years. So in this example, they would pay $9.4 million of interest. Those are the interest payments in years 2 through 14, plus the first year premium of $3 million, making their total outlay $12.4 million, just a little bit less than the 100% finance model we looked at earlier. But due to pulling out less cash to pay off the loan, the Leveraged Index Arbitrage program produced 24% more cash value and death benefit by policy year 30. Again, the client doesn't need to post any outside GAAP collateral, and they don't need to sign a personal guarantee, which is a huge benefit to the client. And for the clients that say, well, I have the money, why don't I just pay the full premiums in the non-finance policy? Why would I want to introduce leverage? Well, if it costs you the same, or sometimes even less, when you use leverage, and you are able to get a bigger policy, mathematically it makes sense to use premium financing. Again, it's not a matter of not having the money, it's about using your money most efficiently to get the best return on investment possible. That is what using leverage in life insurance is all about. Leveraged Index Arbitrage, a better way to finance life insurance premiums. Brought to you by Landsmark Capital.